Hey, Renter Retires, it's Adam Schroeder here with another episode, and I am joined here today by Dale Wills. He is the founder of Centra Companies, and we are going to dive into the single-family world. Dale, thanks for joining us today.
Thanks for having me, Adam. I'm looking forward to the conversation.
Yeah, so let's start with the question we start everybody off with, and that is, what was your first real estate deal, and how did that go?
Oh, geez. I'm not even sure I can remember.
What's the first one you remember?
That's a really good question. I've been involved in real estate in some fashion most of my life. So the first one I would remember was a house I flipped when I lived in Vegas. When I was early on, married in my early 20s, we bought a house down there and ended up flipping it pretty quick and made a couple of dollars and moved on. So that's probably the first one I can remember.
Okay. And do you remember what's a failure that sticks out in your mind? Because a lot of times what we experience with investors is they get started, things are good, they're rolling, the cash flow's coming in, and then an expense hits, and the immediate thought is, well, this doesn't work, I'm out. So tell us a little bit about maybe a road bump that you hit earlier in your journey and kind of how you decided, hey, let's keep going down this path.
The biggest failure I've had was not real estate related, but really impacted my real estate career. I used to be involved in Radio Shack franchises. I owned several of them. We had a lot of success. One of the stores was the biggest franchise in the world. And then when 9/11 happened, the attack on the U.S. soil, retail just plummeted, and we ended up having to file personal bankruptcy and lost everything. And I take that into real estate because, really the lesson I learned is you've really got to stay on top of the financials. You've got to know and understand. So often, we're making a lot of money and we're not understanding the accounting, and then all of a sudden we have, a quarterly tax payment due or property taxes are due, and that catches us by surprise. I'm a big believer in the language of business is accounting. And so you've really got to stay on top of that. But as a result of that experience, albeit not real estate related, it has helped us to be successful today because it really taught us, and you've got to watch those financials and really know what's going on and learn it and speak that language.
So whenever you say know the financials, like most people are like, well, I have a mortgage payment. I've got, management experience, management expenses, maybe some repairs. So what exactly do you mean when you say you have to know the financials? What financials exactly are you talking about?
I think it's everything you said, plus you need to add, what are capital expenses that you're going to have? At some point you got to replace that roof. At some point you got to replace the driveway. You got to replace the carpet. You're going to have those big capital expenses. Are you setting aside reserve accounts for those? Are you setting aside reserves and understanding, if you've got employees, there's tax consequences that, depending on your size, that are monthly, quarterly, or annual. And so are you understanding your finances and your accounting to be able to say, yeah, I've got to set aside for all of these things and be forecasting what could go wrong. All of a sudden a furnace goes wrong and that puts somebody sideways when they're first getting into it.
Yeah. Is there any, you're just using like an Excel spreadsheet or using QuickBooks, anything in particular you'd recommend to people to kind of start tracking their inventory, start tracking their portfolio, especially as they have, maybe 1 to 5 doors in their portfolio?
Yeah. When you're that small, a QuickBooks or something is perfect. We're much larger. And so we're using a more advanced software. But you get something that with QuickBooks, make sure you have a budget. Put a budget in, think about what are all the unexpected expenses that we could have that we set aside. For us, an example, we have set-asides accounts for the unexpected. And then periodically we take a percentage of that and move it to the bottom line as income. But we have that in reserve in the event we've got to replace the shingles on a 100-unit building kind of a thing. And so, create a budget. Go in, use a software like QuickBooks. Intuit Online is a fantastic software as an example, and make sure you have a budget, that you're living by that budget and you know that budget.
Yeah. All right. Fantastic. So what was it, you got started, you mentioned kind of flipping homes in, flipping a home in the Vegas area. based on everything I've read about what you're doing now, you're not flipping homes in the Vegas area anymore. Talk a little bit about your progression through the real estate space and kind of why you transitioned into each of those areas.
I mean, what I do know is I love real estate. All of us that are in real estate, we're making a difference in people's lives. And I love that. If you think about it, you invest in a home and you have the ability to impact memories for a lifetime. This is where kids are learning to ride their bike and playing ball in the backyard, enjoying a meal around the table. We're facilitating that. That's pretty cool stuff. And so for me, I did that in Vegas. I was also doing banking. So construction lending, development lending, mortgage lending for a period of time. From that, I had a company that asked me to come work for them that was a client. And we were building 300-400 homes a year. That were mostly all entry level. Then went to work for a company that actually created a city from scratch. So we had to create the water company, the sewer company, the golf course, the apartments, the grocery store, everything from scratch. And that was really fun and a great learning experience. Then I did another home building company on my own for a period of time. Did the Radio Shack franchises. I guess I have that backwards, but when I did the home building, I ended up selling that company. Somebody approached us to sell, and so we sold, and then went to work for a national real estate company. And they asked me to move to Minnesota, and my confession, I had to go look at my computer and figure out where Minnesota was exactly. And said, yeah, I'll go, but 3 years max. I don't want to stay there. And that was 18 years ago. So we moved here. The market fell apart. We moved here in 2006. Market fell apart and started in 2006. In earnest, fell apart in 2008. And I went to them and said, hey, I want to go back out on my own again. I'm going to stay in Minnesota. And they said, well, if you're not going to be there, we don't want to be there. Would you just buy our assets? So I ended up buying all their Minnesota assets. And then we worked with banks. In 2010, 11, 12, 13, a lot of these banks were holding assets they didn't know what to do with it. They foreclosed on. And so we worked on buildings that were partially finished, buildings that were finished they didn't know what to do with, partially developed lots, partially developed land. So we helped them work through that. And that ran its course. And we ended up buying a large portfolio, just paid cash for it, of 450 properties from a lender. And then we looked at best use of each. We had one that we turned into 120 different single family lots, and another one we turned into 60 different properties. And so we worked through all of that and then started developing again. And 8-9 years ago, we jumped into apartments. And so mostly all value add. We don't look for an opportunity that I could just flip it real quick. We're now primarily we look for value add, something that I can increase its value, whether it's building it from scratch or improving, a rundown apartment complex. And then today we're mostly focused on for sale housing and for rent housing, because that's where we see the market opportunities are. Apartments will come back. We're excited when it comes back, and we're seeing some indications that we're getting closer, but it's not today. And so we're doing, early on stuff to be ready for that. But mostly it's all housing that we're putting our energy in today.
Yeah, no, you mentioned the Great Recession, and there were, a lot of times we look back on it now and we see, and we're like, man, I could have bought a home for $40,000 that had so much upside because the bank was just trying to offload it. And we see the opportunity too late. I think that's true throughout all of history. So how are you finding the opportunity? You mentioned how you're doing the for sale now because that's where you see the opportunity. How did you see the opportunity, and how can people visualize where that opportunity is coming from in a time where, like right now, they're thinking, oh, well, prices went up during COVID. Interest rates are higher now. Why should I get invested whenever the prices are a little bit higher and interest rates are higher?
Yeah, I'm a huge believer in you'll find what you're looking for in life. I talked about doing a flip in Vegas. My wife and I lived in Vegas for a couple of years, and we hated it. We hated everything about it. And what I learned from that, though, is we found exactly what we were looking for. We looked for all the reasons to hate Las Vegas versus all the wonderful things. It had some really great people that we grew close friends with, and some great mountains to go hiking, and a fantastic recreational lake. We ignored all that. We focused on what we didn't like about it. And that was a really powerful lesson to me, because I'm a big believer in you'll find what you're looking for. If you look at interest rates, lots of people, I'm hearing this from people, well, I'm going to wait for interest rates to come down. I'm going to wait for it, and fill in the blank. So an example would be is if we go back to the 60s, interest rates were relatively low in the late 60s. And then they started climbing in the 70s. And they didn't stop climbing for many, many years. In the 80s, people were paying high teens, low 20s on some of these interest rates. They didn't really start coming back down again until the 90s. And so if you look at that, a lot of people said, I'm going to wait for the right opportunity. I'm going to wait for interest rates to change. And they sat around and waited for over 20 years. And I don't know, the market's different, but I don't know that we're in too dissimilar circumstances. If you're going to wait for interest rates to improve, you could be waiting 20 years and you're going to lose out on 20 years of wealth. And so the key is to go be creative, focus on what you're looking for and it'll show up. Great example, I was talking to a guy that he's a house flipper. And so, he said, hey, foreclosures are picking up again. And so he worked out with a guy and he said, that's a real estate agent. Every time a foreclosure pops up, email it to me. I'll look at it. If we like it, we'll buy it. I'm going to give you a reduced commission. And then you can sell it on the backside and I'll go in and put new carpet in, paint it, whatever we need to do. And I'm going to flip these. And he said he's doing 2 to 3 of these a month and he's getting way more foreclosures to look at than he can handle. And he says he's making a ton of money doing this, more than he's ever made in his life. And this is right now when interest rates are terrible and there's no opportunities and we should all wait for the opportunities. So that's an example. For us, we're doing enough volume. That doesn't make sense for our business model. But if you're getting going, there's opportunities all over the place. Just start looking for them. But if all you're going to see is interest rates are high, that's all you're going to see.
Yeah. I always remind the investors I talk with, and I say, look, right now you buy it. Let's say you get a 7.5% interest rate, which investors can get right now. I said, there's 3 things that are going to happen. Number one, interest rates are going to go up. And people are going to be staring at you like we're looking at the people who have 3% interest rates, right? Like if they go up to 15, people are going to look at your 7.5 and go, hey, how did he get that? How did he get that? He's so lucky. And rents are going to go up with it, right? Or they're going to go down and you have the ability to refinance, right? Or they're going to stay flat. And we've seen the prices in most of the good areas that you want to invest in aren't really dropping. So then you're going to end up owning the same asset and controlling it and seeing whatever growth you have and getting the tax benefits. And you have the same interest rate as the guy who bought 2 years from now. So, really,
I think you're spot on. And you hit a really great point. If this thing pencils, if I can make this thing work at a 7.5 interest rate, go do the deal then. And if interest rates drop, how much more are you going to make when you refinance that sucker?
Yep.
So go make money, go do deals. If they go up, you've got a really good deal with 7.5. If they go down, you've got a screaming deal because you just refinanced and you're making a ton of money.
So what areas of the country are y'all looking in? Are there any particular spots that you find the most enticing for people to look in?
We're primarily focused on Minneapolis right now. From a national standpoint, we like the markets that everybody's not flocking to. So there's a ton of money flocking to Texas and to Arizona and to parts of Florida. And, I can go to those markets and hit a home run, but I can also strike out a lot. And, those markets are so cyclical. The highs are really high and the lows are really low. I'm a bigger fan of let's go hit a whole bunch of singles and doubles and get on base. And so we like the markets that, are really overlooked. The Sioux Falls, South Dakota, or Kansas City, Missouri, or Indianapolis, Indiana, where there's not as much money flowing there. Now, granted, I'm not going to hit the home runs in those markets that I would, in an Arizona or a Texas or a Florida, but at the same time, I've mitigated a lot of my risk. And so we're more of a conservative company. That I'd rather make a little bit of money and feel secure than making a ton of money and risking it all.
Yeah. So what is it about? I mean, I know obviously you live in Minnesota, so that's one thing. But what is it about the Minneapolis area that you like for the long-term investments?
I think the most attractive thing specific to Minneapolis is the diversity of Fortune 500 companies. You go to a lot of markets and they're dominated by a single industry, whereas Minneapolis, Target is headquartered here. 3M is headquartered here. Medtronic and Guidant, which are big medical device companies, are headquartered here. General Mills, a big food company, Cargill, a big food company, are headquartered here. Best Buy Retail is headquartered here. U.S. Bank is headquartered here. So it's the diversity is one of the things I really like about this particular market, is because, if one industry fails or is really struggling for a period of time, there's a whole bunch of other industries. And as a result, when the recessions hit, those markets that are a little more diverse weather it quite a bit better.
Yeah. And I always like to say, you mentioned kind of the on-base thing is whenever you get up there, if you keep hitting singles and you keep hitting doubles, eventually you get hold of one, right? Like if you just keep up there swinging and that single you thought you were going to, or the double you thought you were going to hit, we keep going with the analogy, it gets past an outfielder, right? And you end up rounding third and coming home. And you can just never tell. I mean, you can go into areas where there's high growth and know that you've got a pretty good appreciation ability, or you get into the solid places that are just nice and steady, but there are always pockets in that area that are gonna boom, and you don't necessarily know which ones they are. Like I have a couple of rehabs like in Memphis that I would have thought they're just gonna be nice and slow and steady, but they've doubled in value over the last 5 years. But if you'd asked me 5 years ago, hey, is this gonna double in value? No.
That's a great example. I was involved. This is, I'm going to say about 12 years ago. We bought about 800 apartments in Memphis. It was about 40% occupied. We picked these things up for about $4,000 a door. Jeez. And we went in and just started rehabbing. Now keep in context with the time that
there's a reason they were $4,000 a door.
We were in and said, okay, let's paint them and put some new carpet in and just do some basics so they're a little more habitable and start renting these things up. We were 9 months into it, and we didn't even have them half done. And somebody came in and offered us cash at a price that it was like, we'd be stupid to say no. And we thought that'd be a single or a double, and it turned into a home run. It was a massive return that we got on that deal, enough that it was like, I don't even think we're going to wait for the 12-month mark so we could do a 1031 or, some tax advantage, because this is so much money and it's so silly that let's just take it and run. And we did. That's a perfect example of what you were saying of, we planned on doing a single or a double on that and doing well and being happy, and turned into a home run. And so you keep swinging long enough, the outfielder's going to miss.
So what metrics do y'all look at? Because there's so many different metrics in the real estate world that, you hear all about. There's acronyms, there's, full names. What metrics do y'all look at just real quick to say, is this even a deal we should go a little bit further down the rabbit hole on?
It's interesting you say that, because, in fundraising, when we're allowing people to co-invest with us, the industry kind of says do IRR, internal rate of return. I hate that number. You can manipulate that number a million ways, and nobody has any idea, and it can be so deceiving. We produce the IRR. We tell people what it's going to be, but I'm not a fan of it. We really look at what is our return on our investment and time. So if it's for sale housing, we're looking at our investment of time, and we're looking for a specific gross margin that we're going to return on the sale of the house. If it's a for rent, we're looking at it and saying, what's the hassle worth? If I'm only going to get $100 a month, that may not make sense for a single house. But if I get $100 a month on a 100-unit apartment complex that's going to appreciate over 10 years, that might make more sense. So we put a lot more into it also because we look pretty closely, because we have a lot of income as a company that we don't have tax advantages. So we also really put a lot of emphasis into depreciation, bonus depreciation, cost segregation, and what that's going to do to our tax liability is pretty important. So unfortunately, it's not a really simple answer as you get a little bit bigger and doing a few more deals.
Yeah. All right. Well, let's go to, if you were talking to a newer investor, is there any particular metrics you would say, hey, when you're evaluating that single family house, I highly recommend that you consider this metric?
Yeah, I think you've got to look at it and say, what is all your expenses? What are the expenses that are going to come up that you need to be setting aside for? Then you say, what is your time worth? You need to factor in, you're going to have a vacancy rate. That's always going to be there. When we turn an apartment or a house, we feel really fortunate if you can turn it in a week, because you got to go in and shampoo the carpets and you got to clean it we figure that's a home run. But even then, that's still a week. When there's 52 weeks in a year, that's lost income that you've got to factor in. Plus, you've got to factor in what in the cost to clean the carpets and repaint, whatever you've got to do. And so you need to put all of that down on paper and say, okay, what are all of my expenses? And then what is my time worth? Is it worth $100 a month for this unit, or do I need $500 a month? And so I think it's really a personal thing, but the most important is make sure you're not missing an expense. Make sure you're not missing the fact that you will have some vacancies. We just had a unit that somebody shot themselves in, really tragedy. But you know how much that costs to go have somebody go do the biohazard and cleaning up that apartment, and how long that thing sat vacant because we didn't know that it was going to be vacant. And so you need to have some set aside for that unknown. That's where I see people make the biggest mistake, is that they don't plan for the worst case scenario. And so you got to plan for those things. And then just, once you've done that, is what is your time worth? And when you're doing a unit here and there, your time's not worth as much. And so, $100 a month, positive cash flow is probably worth doing it. Go do it. But as you grow and your portfolio grows, that 100 might not make as much sense. And so it's a vague answer, but I think it's really personal.
Yeah. All right. And so as you talked about kind of what happened during the Great Recession and all of that, where do you see the next few years taking the real estate space, primarily in the single family world?
The single family, there's a lot of different states and Congress has talked about outlawing corporations owning real estate, and just very a short-sighted proposal. And I don't think that'll get legs. However, they're not going to do it retroactive. So if that were to ever happen, if you got a portfolio, you're in pretty good shape. There's a huge need for housing nationwide. And we're seeing that. We're doing some for sale housing right now. We build everything on speculation. And what that means is we don't sell it until we're halfway done with construction. Everything we're building is selling. In the last 6 months, we've had one house we got finished. So we're selling everything in less than 45 days. And because of that, people need to rent houses. And what we've learned is we have apartments and we have houses that we rent both. People in apartments, and this is not a blanket statement, but generally speaking, people that are in apartments want to own a house eventually. People that are renting houses want to rent a house, generally speaking. They don't want an apartment. And so there is a need, whatever the life circumstances are that are causing me to want to rent a house, those metrics are going to stay the same. And so if you have a house that's for rent in a market that people want to live in, people need houses. And so go do it. Go build your portfolio up. If you just do a house a year for the next 30 years, you're going to retire really wealthy.
Yeah, absolutely. So as we wrap up here, I would like to just talk a little bit about kind of, what your company is doing in the real estate space, who your company would be best fitting for, so that our listeners can know, see whether or not it's a good idea to reach out to you.
Yeah, about 3 years ago, one of the things we give our employees is the opportunity to buy houses at cost. And so we have several that they will buy them as frequently as we allow and turn them into rentals. And they've got immediate equity. And our goal is we want to help everybody. Our focus as a company is we improve everything we touch. And so if I can help my employees build wealth right alongside me, that's awesome. Let's do it. Well, I was visiting with one of them that takes the most advantage of this, and looking at his tax consequences and my tax consequences are so different because he's W-2 and I'm self-employed. I thought, this is travesty. I can build my wealth much faster than he can just by the mere fact of the tax consequences. I said, this isn't right. And I need to do something to help these people that I care about and love to grow their wealth. And that evolved into today. And this, about 8 months ago, we started a company called Centra Partners that allows our employees to take their IRA money, take their bonuses, and invest it pre-tax into the developments we're doing. And we decided last fall, if we're going to do this, let's allow other people, friends and family, anybody that wants to go invest and build wealth with us, let's let them do it. And so we've launched that. We're really excited about that. And right now, the only investment opportunities we have is on for sale housing. So somebody can co-invest with us on projects we're already doing. We're selling the houses. And in effect, they become a part business owner in that project that we're doing, and they get returns on that investment. And then the hope is that they reinvest in the next project. So we're really excited about that, specifically for our employees and what it's doing, how it's going to afford them to build wealth. And then the idea of, let's open up to anybody and we can do more deals that way. Because we feel like we don't feel like, we know we're really good at what we do. And so why not allow other people to join in and build some wealth together?
Yeah, absolutely. And the website is, you see it right here on the screen, the centracapitalpartners.com. That's centracapitalpartners.com. I really appreciate you joining us here today and talking about everything that investors need to know, areas to look at, and all of this that you brought with us. Again, Dale Wills is the founder of Centra Companies. You can find the website at centracapitalpartners.com. You can find us at renttoretirement.com. That's renttoretirement.com. See what single family homes we have available for the interested investor. And we have our expected returns right there on the sheet that you can find at renttoretirement.com. Again, as always, if you have any questions, please email them to podcast@renttoretirement.com. That's podcast@renttoretirement.com. Thank you so much for taking the time to educate yourselves today. We'll talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.